So how is it actually possible that the broader market is rallying, right? Yet the very stocks that have driven our portfolio gains for the last year are suddenly in absolute free fall. We literally just witnessed a massive intraday drop in the semiconductor space. And this really highlights a stark and growing divergence in the markets that all of us need to understand right now, especially before the Federal Reserve makes its crucial decision tonight.
The number we really need to focus on right now is 6%. The SOX semiconductor index plunged as much as 6% in a single day. That's a massive hit, and it officially extends the Nasdaq's losing streak to 5 consecutive sessions. Based on available data, the message from the market is just crystal clear here. The momentum is sharply shifted.
With a shift this drastic, we really need to unpack what's going on. Hello everyone, welcome back to AI Market News.
Section 1, the old versus new divide.
As you can see in the charts, the contrast is honestly striking. On one hand, we've got the Dow Jones gaining 537 points, closing up at 52,747, and that was lifted by strong earnings from traditional giants like Boeing and Coca-Cola. But on the other hand, the Nasdaq fell another 55 points down to 24,877. So old reliable businesses are catching a bid right now, while the high-flying tech sector is just being heavily sold.
What we're actually experiencing here is a classic sector rotation. And why is this happening? Well, it's because investors are locking in their massive profits from AI and semiconductor stocks, and they're actively moving that capital into safer, value-oriented assets. According to current market information, funds are basically seeking shelter in cyclicals and defensives as the overall economic outlook becomes just a bit more uncertain.
Which brings us to Section 2, warning signs emerge.
Economic anxiety is absolutely starting to bubble up right underneath the surface of the Dow's rally. For instance, July consumer confidence completely missed the consensus forecast, dropping to 90.8. The present situation index dropped to its lowest level since early 2021. The underlying mechanism here is actually quite simple. Consumer spending accounts for roughly 70% of US GDP. So, when consumer confidence drops this sharply, it signals to all of us that the broader economy might actually be slowing down much faster than anyone anticipated.
And this economic shift is also reflected in the energy sector. The graph shows crude oil continuing its sharp decline, with WTI settling at $79, which is down over 4%. Why? This is happening because diplomatic progress and a potential memorandum of understanding between the US and Iran are reducing that geopolitical war premium in the energy markets. That further eases inflation pressure, sure, but it also clearly reflects softer global demand.
Moving on to Section 3, tech drags down Nikkei. Let's look at the impact on Japan, where the effect of this US divergence has been immediate and severe. The Nikkei 225, Nikkei Heikin Kabuka, dropped another 930 points to close at 61,434. At its lowest, it briefly fell below 60,450. To put that into perspective, this brings the massive two-day decline to roughly 3,500 points. That effectively wipes out weeks of steady gains for local investors. Just gone.
Meanwhile, as you can see in the chart, the USD/JPY, Bay Dollar N, is hovering right at 163.65. For Japanese investors trying to navigate these massive equity drops, this currency dynamic is absolutely essential context. Shifting yield expectations in the US directly influence the yen's strength and, consequently, the profitability of our export-heavy index.
So, what's the actual reason behind the Nikkei's drastic fall? Well, it's directly tied to the US. Heavy selling in American semiconductors heavily dragged down our local tech giants. Tokyo Electron, alone carries such a massive weight in the index that its decline single-handedly pulled the Nikkei down by 603 points. It's like they say, right? When US tech sneezes, Japanese tech catches a cold.
Now for Section 4, all eyes on the Fed. This brings us to the main event of the week, the catalyst that could either accelerate this rotation or totally reverse it. At 2 p.m. ET tonight, the highly anticipated FOMC decision officially lands. Right now, swaps are pricing in a 70% probability of a hold and a 30% chance for a hike. Because the Fed chair has deliberately avoided giving forward guidance, the market literally cannot fully price in the outcome.
So we really need to prepare for 3 specific scenarios tonight. First up, a hawkish hold. Equities might see a muted reaction there, but we'll have to closely watch the dot plot for future rate projections. Second scenario, a surprise hike. No way around it, this could trigger a sharp growth stock sell-off, potentially testing the S&P 500 right at the 7,300 level. And third, a dovish hold. If the Fed actually acknowledges the slowing economy, well, this could spark a massive relief rally, particularly in those beaten-down semiconductor names we just talked about.
Finally, Section 5, Economic Calendar and Earnings.
Beyond tonight, we've got a gauntlet of crucial economic catalysts that will shape the rest of our trading week. Looking at the horizon, Microsoft and Meta report their earnings tonight. Then, Thursday morning at 8:30 a.m. ET brings Q2 GDP and the absolutely critical PCE inflation gauge. Apple and Amazon report Thursday night. And finally, on Friday, we have the BOJ decision along with Governor Ueda's press conference, which, for sure, will be vital for the yen's next move.
So, wrapping this all up, tonight's Fed decision is undoubtedly the fulcrum of the week. With a weakening consumer, falling oil, and those semiconductor stocks under serious pressure, whether the Fed acknowledges these cracks or stays stubbornly focused on inflation is going to set the tone for the months to come. So, the question really remains, are we just witnessing a temporary blip or the end of the AI-driven bull run? Thanks for watching. Please subscribe and hit the like button. This video was automatically generated by Gemini Notebook AI. AI-generated content may include errors. This video does not constitute investment advice. For full details, please check the description below.